Hey everyone, Dave Keller here with Market Misbehavior. A lot of conversations this week about a market that reversed abruptly from a period of weakness last week, really into the Friday close, which was at the lows of the week, to all of a sudden this week where we rally right from Monday through Wednesday, Thursday, and even Friday. And that's through the Fed, that's through a Treasury auction, that's through some significant earnings, including Apple, which was not particularly a strong earnings release. Through all of that, this market has moved higher. Today, we're going to do a little multiple time frame analysis on the QQQ. Let's decide together what we see might be next for the Nasdaq 100. So I get asked a lot about multiple time frames, right? And I often catch people just insisting that there's one time frame, right? Is this bullish or bearish? Is this going up or down? Should I buy this or not? And my follow-up question to any of those questions is, what's your time frame? And in a lot of ways, it depends very much. If you're a long-term investor, I would argue the patterns you've seen with the QQQ recently with this recent drawdown, the fact that mega cap leadership growth names have been pulling back quite a bit, great opportunity to layer in over the long term. If you're a medium-term investor looking out 1, 2, 3 months, I would argue still to be determined, right? There's been this nice rally off the lows, but we're still within a downtrend channel, as you'll see in a minute from the Qs. If you're a short-term swing trader, hopefully you've been tracking this upswing because we bounced right off the lower end of the channel. We're trading right up to the upper end of the channel. So you have to really think about these multiple time frames. We're going to look at the chart of the QQQ. I'll address those 3 different time frames. Also share a market trend model that I designed years ago to try to automate, or systematize this sort of multiple time frame analysis. Before we get to the charts, one more thing to tell you about. Today's video is brought to you by Seeking Alpha. I'm a big fan of places that allow you to better understand the market environment. I think seekingalpha.com is certainly one of those. When you go to the website, I would check out the stock screener, particularly because it allows you to use Seeking Alpha's proprietary quant model. In my experience working with institutional investors, we always had what's called an alpha model or a quantitative model, which really modeled the characteristics of strong companies, demonstrating strong growth prospects and strong price momentum. Seeking Alpha does a really good job of taking that institutional level quantitative capability and putting it in the hands of individual investors. If you go to marketmisbehavior.com/seeking alpha or just click on the link in the description below, you can go right to a special offer. If you use the link, you get $50 off your first year and also get a 7-day free trial to check everything out. So go to marketmisbehavior.com/seeking alpha. Now back to the video. All right, so here's the chart of the QQQ, and what I'm immediately drawn to when I look at the chart of the Qs, the chart of semiconductors, to a lesser degree, this chart of the S&P 500, this downtrend channel. And when I say downtrend channel, what I mean is a parallel decline of lower highs and lower lows. All right, so look at the market from, and this is the Qs again, from January of 23 to mid-July of 23. Fairly consistent pattern of higher highs and higher lows. When we rally, we eclipse the previous high. When we pull back, we tend to find a low above the previous low. You'll find most of the time here we spent above the 50-day moving average. We had a couple brief pullbacks to the 50-day, which were good buying opportunities as this uptrend continued. Look at how everything I just said changed in the month of July into August, when all of a sudden we went from making higher highs to lower highs. And I would argue that lower high at the end of August, when we started to roll over, told me a great deal about the market conditions at that particular point. Suggested to me, now that we're not making new highs, that means that buying power that had gotten us to that level starting to dissipate a little bit, starting to see more weakness. Now we can draw a parallel channel on the highs in July, August, September, and October, and also draw a parallel channel down to the lows in August and October. So basically, it's been an incredibly orderly pullback, a corrective phase for the Nasdaq, for the semiconductor space. Some individual names kind of have this classic pullback pattern, and not all stocks. Obviously, there's quite a bit of diversity in the equity landscape at any point, but particularly the mega cap and large cap growth space looks a lot like the chart of the QQQ right now. So let's talk about these 3 different time frames and how we can use this daily chart to try to make sense of it, and maybe when we want to start using some other charts as well. Let's start with that short-term time frame, that tactical time frame. So when I see this rotation to the lower end of this channel, and again, I drew this a while ago when I saw this lower high. I drew a trend line thinking, all right, this is a good trend line off of the peaks. And I also drew a parallel line saying, all right, if this is a channel, then we want to start to anticipate support when we get to the lower end of this strategy. So when we got to late October, we were testing the lower end of this downtrend channel. The RSI was very close to an oversold reading, suggested to me, boy, maybe we're at sort of that short-term bottoming point. On top of that, look at the 200-day moving average. Very, very close to just below the lows there in late October. The first Fibonacci support level, take the December 22 low and the July 23 high, 38.2% of the way. It's right around 338. That's not too far above or below where we ended up bottoming out in October. So you had sort of this confluence of support. And my toolkit really not designed to optimize. I'm not trying to pick a point, right? Pick one moment where I say, all right, that was the low. I think a lot of people spend way too much time and probably sugarcoat their abilities to pick turning points as they happen. It is incredibly difficult. I'm much more interested in trying to anticipate those levels and then trying to validate that those levels have occurred. So part of my toolkit is more leading, and this is some of the things we've talked about. A particular level of support, focusing on the 200-day moving average, looking at momentum and seeing what the characteristics are like. Then the rest of the toolkit is more lagging, identifying when we've had that bounce off of the lows, making sure you capitalize on that if you're more of a swing trader. So from a swing trading time frame, a move like this represents some good opportunity because it suggests we could move back to the upper end of the channel. Don't look now, that's basically what's happened this week. Over the last 6 or 7 sessions, we've traded down to the lower end of the channel. We've now traded right up to the upper end of the channel. Now, here's the kicker. In that swing trading, what I call the tactical time frame, that short-term time frame, you have to remember now we're at the upper end of the channel. So sort of the opposite of what we talked about. So one of two things, of course, can happen. This channel continues, at which point the market has rallied about enough for a bear market rally. And as long as we remain below that trend line, and if we break above it, really the highs from mid-October, because that's what would continue to make it a lower high. If we peak out around current levels, that would continue this downtrend pattern that we've observed since July. If we break above 375 and get above the October high, I would say that tactical time frame continues to be strong. The other thing to look for would be the RSI. Look at how the RSI has rallied from almost to the oversold level to an RSI around 60. Now in a bearish trend, when the trend is going downwards, you often find a rally will stall out around 60. That's what happened here in late August. That's what happened here in the second week in October. Those are the other times we went to the upper end of the channel. The RSI got right to 60 and then kind of rolled over. You see the opposite in a bullish phase where the RSI becomes overbought on rallies and pulls back to just around 40 on pullbacks. That's what tells you we're in more of a bullish phase. So on the tactical time frame, I'm a little bit concerned because we've had a pretty good run this last week in the face of some concerning news from Apple and others, and also we're at the upper end of this channel. So I think we're nearing some resistance. I might expect a bit of a short-term pullback, particularly around that RSI 60 level. But I hinted a little bit at that medium-term time frame, right? 1 to 2 to 3 months out, right? When we think about that, I think this is still the overlying principle here, right? We had an uptrend in the first half of 2023. Now we're still in the downtrend, and I just haven't seen enough evidence here to tell me that the trend, that medium-term trend, is changing. What would I need to look for? I would need to look for, as I mentioned, the price getting above 375. That would take us out of this channel and make a new high. So that would eliminate that downtrend definition that we clarified. The RSI would have to get above 60 on the next move higher, potentially continuing into next week, to show that there are additional buyers coming in willing to push the price of the Q and these leading growth stocks even higher. What you have to remember on that medium-term time frame, if we do then rotate to more of a constructive phase, suggesting higher highs for the Nasdaq, you have to remember that tactical time frame, that swing trading time frame, is still going to have short-term peaks and valleys. So just like we have a downtrend channel here, you might want to draw a trend line off of the next higher low, which would be another thing I'd be looking for that would tell me that medium-term time frame is starting to turn higher. So far, our playbook looks like this. Tactical, the short-term, bullish. It's so far in the last week until proven otherwise, but I'm concerned that we're at the upper end of the channel. The medium-term time frame, not enough evidence, I would argue, yet to tell me the medium-term trend is more positive. It's still negative because we're still in this channel. So we have to get out of that channel, get out of this pattern of lower highs and lower lows to tell me the trend is changing. Now, here's where it gets to the really interesting one. If you're more of a long-term investor, if you're looking years out, if you're planning in a retirement account, it's pretty reasonable to expect that the long-term trend is still positive. And if you think about it, the fact that we've remained above just a brief Fibonacci level, we're still above the 200-day moving average. I was taught nothing good happens below the 200-day. And when you see a break like you did in January of 2022, where the Nasdaq has been above the 200-day pretty consistently since the COVID low, and then all of a sudden breaks below, and you have a couple of these retests that fails. That's what tells me that that long-term time frame, looking at a year or so, is still, and of course there's a very long term even beyond that, but that sort of general long time, looking a year or so out, that's what tells me that that long-term trend is still down. That doesn't mean you can't have tactical bounces. That doesn't mean you can't have medium-term trends that are actually quite constructive. But that long-term trend is more, more overall, a little more distributive, and that tells me to be more cautious. So for now, the long-term trend, I would argue, still constructive. The other thing you can do is go to a weekly chart, right? Go to a longer-term chart. Here's the weekly chart of the QQQ. It's not that bad, right? Here's that corrective phase we've experienced in the last couple months. We're still above an ascending 200-day or 40-week moving average. We're still above the 150-week, which has served as a pretty important level to watch going back through market history. So overall, not too bad. So I would argue that there's still certainly some upside to be had. I would have to see more of a deterioration than we've seen so far to have some real doomsday scenarios, thinking about the S&P testing further lows, although my last video really did talk about some downside objectives. So if you are seeing a downside rotation, make sure you check that one out, because I think that'll give you some ideas about where some potential downside objectives could be. I'll put a link in the description below. So here we're left with long-term still constructive, medium-term I would argue still weak until proven otherwise, and the short-term trend certainly strong, but concerning that we're at the top. That brings me to what I call my market trend model. Years ago, I designed this combination of weekly exponential moving averages to just validate that analysis that we did. Now, what I just did was a subjective analysis. I looked at the charts, thought about those different time frames, a couple days to a couple weeks, couple months, year plus, and thought about what the chart was telling me about the trends over those time frames. But I found by using a series of exponential moving averages, I could pretty much approximate the analysis that I just did. We see here the long-term trend is bullish because we're above the zero line. The medium-term trend still bearish because we're below the zero line. The short-term model, and I update it every Friday at the close, so pretty likely, barring some huge sell-off in the next hour or so, that the short-term model will finish the week bullish. So just like that, in about 10 seconds, we validated those same things, right? The long-term trend still okay. The medium-term trend clearly negative. The short-term trend, the tactical trend, constructive, bouncing off of those lows. This is called my market trend model. It uses this combination of exponential moving averages. I have done some videos where I explain this in a little more detail. I'll put a link to that one below as well. So if multiple time frame analysis is of interest to you, I would encourage you, don't just look at a chart and start with that basic question, is it bullish or bearish? Always validate some sort of idea, some sort of outlook with a time frame. I'm bullish on this time frame, and I often like to break it up into 3 different time frames. That medium-term time frame, 1 to 2 months, is sort of my sweet spot. That's where I'm mainly trying to focus my attention. But I also have to remember there's a longer time frame for a retirement account, for planning for estate planning and colleges and those sorts of things. There's also a very short-term swing trading time frame that I want to think about, and I'm part of all of those time frames. They all affect me in different ways. So focus on your time frame of interest. Go one time frame shorter, one time frame longer, and make sure you think of all of those trends holistically. I think charts are a really good way to do that. And if you want to learn more about it, check out my premium memberships. There's a lot of good things we could do together to help empower you to better understand these markets using the best practices of technical analysis. I'm Dave Keller with Market Misbehavior. Be well and stay safe, and I'll talk to you again soon.